Welcome to Barchart's series of webinars designed to enlighten you on a variety of investment ideas and concepts, inform you of the features and tools Barchart provides related to these concepts, and offer you some traders' insight to help you make a more informed investment decision. Today's session, cashing in on covered calls. Now, the covered call strategy is one of the most popular strategies because of its versatility, generating income on assets that have a slightly bullish tendency, dampening downside risk to an asset already owned, as well as improving portfolio performance when an equity trades sideways or underperforms against a benchmark like the S&P index. Yet covered calls are not without some forms of risk, like opportunity costs if the stock price rises quickly and above the strike price that the call was sold, or protection from a large decline in the underlying price. Now, although the premium collected from selling a call can lessen the cost effect of a price decline, that doesn't stop that loss. However, using covered calls consistently and effectively can improve your investment realized gains without relinquishing ownership. Hello, everyone. My name is John Rowland, Barchart's senior market strategist. And, not a day passes without me looking for opportunities to employ the covered call strategy. Now, not every day creates an opportunity, or every equity in my portfolio produces a good candidate. Though, over time, the execution of covered call strategies can dramatically increase your overall portfolio's performance. So stick around today as we walk through the mechanics of a covered call, discover its versatility, its benefits and risks, and explore Barchart's features to help you in your selection process. And as we go along, I will offer some tips to help you in your timing and your decision-making process. Now, before we get to all that, please welcome our moderator and Barchart's project director, Jean Baker. Hello, Jean.
Happy Wednesday, John. How are you?
Hump day.
Yeah, hump day. Yeah. Hot hump day here in Chicago.
I think it's hot hump day everywhere.
Yeah, I don't think summer wants to give up quite yet, but
It was kind of funny. Last week we were talking about how we were having our false fall, and here we are now. We're all complaining that it's hotter than Hades, right?
yeah, well, it is what it is. So, you ready to get going?
I am certainly ready to get it. Are you ready to get going?
I am.
All right, let's jump right into it then. Just remember, today's session is for educational purposes only, and decisions to buy, sell, hold, or trade securities, commodities, or other investments involves risk and best made based on the advice of a qualified financial professional. Now, I will add that options trading is not for everyone, and under no circumstances shall we be liable for any loss or damages that you or anyone incurs as a result of any trading or investment activity that you or anyone engages in based on the information or material you receive through barchart.com and our services. Okay, so let's do this. Hang on. All right. So what is a covered call, or how do we kind of define what a covered call is? So when you sell a right to somebody to purchase an asset that you own at a specific price during a limited time period. Now, for that right, a call buyer will pay you a premium for that right to exercise what we call away your asset at that predetermined price and before time expires. So think of a cover call like this. You own a piece of property that you're willing to sell, let's say for $100,000. And a buyer approaches us and says that they want to buy your property, but they don't want to buy it today. They want to buy it in 30 days. And if you allow them to purchase it in a month's time, they will pay you a $5,000 premium for that privilege. And then in 30 days, if they're unable to close or buy that property, then you get to keep the premium. Now, of course, who wouldn't do that deal, right? Right? It seems like a win-win scenario. But actually, it has some risks, doesn't it? First, you're limiting yourself to just one buyer and not allowing for a potential bidding war on your property among multiple buyers. And let's say after 30 days, the real estate market collapses and your property is only worth $75,000. Yes, you get to keep that premium, but it doesn't cover that potential loss. So the cover call strategy has some variances, and we're going to look at two variances. But the basic idea is that we're going to uh, be slightly bullish or neutral to market, where we're going to buy the underlying and sell a covered call or a call above current price, a strike above. And that is going to allow us to collect a premium. Now, the opportunity loss of a covered call would be is if that security increased significantly above the strike price, as your gains would be capped to the strike price that you sold, plus the premium that you received for selling that call. Now, the risk is if that stock or that equity's price depreciates during that time, and that the call that is sold or that premium collected might not cover that potential loss. And maximum profit can only be achieved if the security price increases to the strike price at expiration. So that's the idea of something that's called a buy right call strategy. Now, we're going to look at that in a little bit at the end of today's session, but we're going to look at a different variance of how we can use cover calls. So let's think about some considerations for cover calls. So the first consideration is, do I want to risk having that stock called away? Do I want that risk, right? So in other words, if my call buyer exercises that right to purchase. Now, for instance, I might not want to sell because of tax implications, right? But if I am all right with selling, then I want to pick or select a price that I feel comfortable selling. Now, that price could be based on a dollar value or a percent gain. If I have no attachment to a stock and I just want to maximize my selling price, then I can do that and maybe reallocate some of my capital. So if I'm willing to do that, right, I might still select a strike price that is closer to current price, maybe even at today's price, and therefore asking the market to take away my stock. I just need to be comfortable with that added premium that I'm going to receive in that event. If I'm willing to sell, but I really like to hold on to my shares, so now I'm going to start thinking about selecting strike prices that are far away from current price so that there's a low probability of an exercise. But of course, I want to make sure I'm close enough to generate a relative decent return in the event that it's not called away. So how much time do I want to give my call buyer? Well, time is money. And if my goal is to collect premium and not to have the equity called away, I just want to try to create some income, then limiting the number of days to expiration increases the probability that it won't happen. In other words, that it won't be called away from me. Now, the trade-off is a potential buyer, our call buyer, will demand a lower price for less time. What is my goal? Is it income or maximum gain? If my goal is for income, well, then let's set a bar for what I'm willing to accept. In other words, I don't want to just let the stock price appreciate. I want it to appreciate and collect that reward or that premium, especially if I'm putting that stock at risk to be called away. If my goal is maximum gain, then there's this balance between willingness to relinquish ownership and the probability of an expected move. Now, dividends and earnings or corporate events can have an effect on pricing. Dividends can lower the price of calls, and earnings announcements can increase the price of calls. Applied volatility measures the annual potential price movement. In other words, a 20% implied volatility is the market is pricing the potential of a 20% price change in a year's time. Now, the importance here for us is that the higher the IVs, implied volatilities, the more potential movement, the higher the call premiums. Low IVs, less movement, lower call premiums. Now, IV is relative to each equity, but during periods prior to earnings, the implied volatility rises. So this is a perfect time to start looking at covered call strategies. And then finally, selecting the right strike and expiration that's going to meet my goal. So it's going to be a combination of all these questions, and the answers to these questions will help me in determining the proper strike and expiration, allow me to meet the goals that I want to achieve for this particular strategy. So for today's session, we're going to go with two assumptions that are both based on prior ownership. So the first is if I'm going to look for income generation with a limited risk of being called away. The second is I'm looking to add performance to a non-performing asset. Now, both I want to hold on to my underlying shares or equities, but I realize that there are these risk and trade-offs. Now, if I'm going to add income and I have no preference to ownership, then the ideal, if I hold on, well, I can continue to sell calls in the future, and that certainly would be the optimal scenario. All right. So what are some criteria that we can look at for strike selection? So the first one would be, again, this days to expiration. Time is money. The more time there is to expiration, the greater the time premium. That is what the value of these calls we're going to sell. Expected move. Now, expected move tells the trader the potential price movement based on current implied volatility. In other words, we'll find an outer range of price probability. Now, this is going to kill two birds for us. First, those low probability prices of being exercised. In other words, how far price have to travel before I would be exercised. And then a fair value for call prices, that premium that we're going to collect. Break even. Now for us, the call seller, it represents the price where at expiration, a price appreciation has negated the premium collected. Or in other words, the value of my price of my stock that is going to be called away. And then return if flat calculates the potential profit if the stock price remains unchanged at expiration. Now, what we're really doing is we're assuming that the stock price is relatively unchanged. And of course, if any appreciation does occur in our underlying asset, that will add to unrealized profits, not until I actually sell my stock and I capture those gains. But if we're looking at return if flat, this is a comparison tool for us. And this is a way for us to rank the reward, the premium that we're going to collect by strikes and expirations. And then proximity, we're going to call this probability. So the closer we are to at the money, the current price of our equity, increases the probability of it being called away. The further away we are from current price, that strike, the decreases the chances of it being exercised. Okay. Oops. Where are we at? Okay, there we go. All right. So let's start off with NVIDIA, and let's just assume a hypothetical here. Let's say that I've been in the stock for quite some time, and I'm really happy with the gains that I've acquired or accumulated. And, I kind of still want to hold on to this stock, but it would be nice if I could, increase that gain that I have made. So, I wouldn't have a problem selling NVIDIA if, let's say, I could squeeze out another 15 or 20% profit. Now, I have to ask myself, where would I be willing to sell and how much time will I allow to pass? So the reason why I picked the NVIDIA example for today is because today, after the close, NVIDIA is going to release earnings. And as we come into earnings events, the implied volatility tends to increase. And so we can look at something what is called the implied volatility in terms of rank and percentile. Now we're going to go a little bit deeper into this in a second, but you can see that on a percentage basis, percentile basis, we're at 96%. That means that the implied volatility for all of NVIDIA's options are relatively expensive, which means this could be right for our call strategy. So where do I start? Well, the first place I'm probably going to start is under the options section is I'm going to look at something called expected move. And now what this is going to do is going to show me the expected move of the different the different expiration dates of varying options dates. So for instance, if we look at the options that are going to expire in 2 days, right, our implied volatility is 195%. That is off the charts. That's telling me that the price of premium for all options is super expensive, and this would be a great opportunity to look for a covered call strategy. Now, how much can we anticipate the price of NVIDIA to move when earnings comes out tonight? Well, it's telling us an expected move about 14.5%, and the upper range in price, because that's what we're thinking about, is around 143.96. Let's just say 145 or 144, just to kind of round that off. So what I can do now is I'm going to go into this option expiration date, and I'm going to go to covered calls. And so I know the implied volatility is really rich, and the expected move is about 15% or around $1.45. So what I can do is I can come down here and look at the 145 call that is going to expire on Friday. Now that current price right now is about 15% away. And now if I sell that call, I'm going to receive $1.44 in credit. That means I'm going to hit that bid, so to speak. And that means that my break-even bid, in other words, what is my effective call away price of the stock that I have, would be 146.44. 145 strike plus the premium that I am collecting. And that would give me, in terms of a value, would be about 1.2% of the price, current price, as it is related to the premium collected. So as a general rule, for trading cover call strategies, we want to try to capture about 1% for every 30 days of time. So in this case, we only have 2 days. So this would definitely fill that criteria. I'm going to get a lot of premium for just a couple days of risk. So the next thing I'm going to look at is what is the probability of this strike price in terms of an occurrence where the price of the stock will rise and I will be called away, or my stock option will be exercised. And so that can be found in what is called the out of the money probability. The out of the money probability of the event not occurring. So in this case, a $145 call has an 85% chance of not occurring, but a 15% chance of occurring. And if that event does occur, then my collective results or profits, potential return, would be 16.7%. So if I'm comfortable with that, I'm saying, hey, if this options event occurs, this earnings event occurs, I could potentially increase the price of my stock and collect a realized gain of 16.7. But maybe I'm afraid of that's too close to current price, or that I want to set a price that's higher. Maybe I want to sell 150 or 160 because I feel like if the Nvidia has a great earnings, it's going to go up $20 or $25 or $30. So let's look at those. So the 150 call, well, I get 0.7%. That's still, if thinking only for 2 days, that's still and beats that 1% for every 30 days. My effective price is 150.88, right? That's what, if it gets called away from, that's effectively what is the price of the stock that I'm selling. And the probability is 90% that it won't happen. It won't happen. So that means only 10% probability that it will. And so if it does happen, that event occurs, then I will gain a 20% profit on the shares of the stocks that I'm going to sell. Now, again, if I go 160, again, it's only 0.3. That's not a lot in terms of percentage. But remember, we're only talking about 2 days. But I want you to notice that most of the gains that we're going to get will be from price appreciation and not from the premium. So that might be something that I want to think about when I'm selecting a strike. But certainly we can look at the probability. It would be a very low probability event, meaning that I would probably collect that premium and still hold on my shares, but how much am I going to make? How much premium am I going to collect? A very, very small amount of a premium. But let's say I'm going to use this increase implied volatility, and I'm going to give my buyer a little bit more time. So let's go back to our expected moves here. And let's go out to, let's say, October. I'm going to give my buyer 51 days. Now, our implied volatility is 63, a lot less than our event that is going to happen today and over the next 2 days. That's certainly an elevated implied volatility. The expected move here is about 23%, or somewhere around $155. So again, let's go to that real quickly. And I'm going to go to cover calls. And I'm looking at the October monthly expirations. And let's look at that expected move, right, of 155. So a 155 call. Now I'm going to take in $3.45, right? And my effective call away price, if the stock is called away from me, then that would be $158.45, a value that I feel a lot more comfortable selling NVIDIA. And my premium is 2.8%. Remember, we only have 51 days until expiration. So if I'm using that 30-day 1% rule, then this would be a very good candidate and strike combination to get a nice premium. And that premium of price appreciation, 23% plus the 2.8%, would give me about 27% premium potential return. And notice that the probability of that event occurring, even though it's 51 days in the future, is about only 1 in 5 that we would get exercise. So there's a higher probability that we're going to probably just collect premium. So this is a great way to kind of see that time can have a major effect on the premiums that we're going to collect. But in terms of expected moves, where if we give our buyer a little bit more time, we can definitely collect a lot more premium. And you see here, we can select a much higher strike price. All right, so let's go to a market that is a very common stock held, and that is Apple. And again, I'll start this process, let's make the assumption that we own Apple. We've had Apple in our portfolio for a while, but there's some things that I'm not so happy about Apple recently. I've heard that Warren Buffett has been selling shares. They have a conference that's coming up. They're going to introduce a new iPhone. I think that's in September sometime, first week in September. So yeah, maybe I feel a little bit more comfortable selling Apple, but maybe I want to get, a higher price than today. Maybe I want to collect, something that's closer to all-time highs or a new all-time high. But again, the first thing I'm going to do is I'm going to look at my implied volatility. So you can see my implied volatility is only 23%. And my rank and percentile, well, first of all, my percentile is in the upper third about, and my rank is in the bottom third about. So what does that kind of tell me? Well, that tells me that my options here are fairly priced. In other words, I'm not going to get a lot of great premium on Apple, but there still might be potential opportunities. So let's go to unexpected move. And so I can see that, if I go out to about 30 days, that my expected move is about $15 or about, 6.5 to 7%. And that upper price would be around 242.35. Now, if we go back to our chart for Apple, that would give me a new all-time high, 242.35. That would be a good price for me. But I might not get that price, right? We don't know if that occurrence is going to happen. Probability says it might, but we still are unsure at this point. So what can we do? Well, let's go back to our expected move, and let's kind of go to that weekly and covered call. And so if we look at the 140, excuse me, the 240 call, which is at the outer range of that expected move, which is only about 5.5% away, I'm going to collect $1.79, which is only 0.8%. Now, that is less than 1% for those 30 days. Now, again, every trade is different, and you can make the assessment yourself, but it is definitely less than 1%. It might not be what I'm looking for. Plus, I would also look at, let's say, what is that probability? Well, the probability, again, 80% that it won't occur. That means, again, 1 in 5. So there's a 1 in 5 chance that I will still own Apple 30 days from now, and I will be able to collect the $1.79 worth of profit. So I would say this would be right on the border for me as a trader. Now, if the event does happen, then I'm going to have an increase of the Apple shares of 6.5%. But again, let's think about time. Let's go out, a couple months. Let's go out to, let's say, October, 51 days, right? And I'm looking at, again, that 240 call. So here I'm getting 1.5%. So I'm about 50 days out, probably still right on that cusp, but a little bit under. So the point what I'm saying here is that in the case of Apple is, yes, I could employ a cover call strategy, but the price appreciation and the potential premium collected does not meet my criterias. It doesn't reach those levels. So what could I do? Well, I could wait for a price appreciation. For instance, a 240 call has a delta. Now, delta represents the change in the price of the strike for every dollar change in that asset. So the delta here you can see is around 29.5 cents or 2.95. So let's just round it up to 30 cents. And let's go back to our chart for a second. And maybe Apple will rally as we get closer to that iPhone event. Let's say we go from where it currently is now, around 227, to, let's say it gets up to about 235. That would be about an $8 move or $7.50 move. So remember, our option increased by 30 delta, or only 30 cents for every dollar. So 30 cents times $7 would be $2.10. And by $8, that'd be $2.40. Now, all things being equal, everything changes in options with time. But a 240 call that today only gives me 1.5%, well, I could add, let's say, another $2.10 to that. So that'd be $5.35. So let's take a calculator. $5.35 divided by, now remember we said the price of the stock was going to appreciate to 235, and that would equal times 100, 2.27%. In other words, I could still be a good candidate on Apple, but maybe I just need Apple to appreciate a little bit more, improving the price of those calls. Today, not a good candidate. Tomorrow, a week from now, maybe a better candidate. So a lot of times it's about being patient and waiting for the trade to come to us. All right. All right, so let's look at that second scenario. And that second scenario was I have an asset that is underperforming, right? It's not really doing much, or it's kind of like stuck in the mud. So some of you might not be familiar with this stock. This is Archer's Daniel Midland. This is an agriculture processor. And recently they had some accounting issues. And the stock market hates that. They don't like that. So the stock price, you can see, dropped significantly on that event. But since then, right? One of the things about when you give a bad accounting, you kind of take the trust away from the street, and so it takes a long time for that trust to come back. In other words, it might take a year's worth in earnings for the market to trust ADM. But what we can see is that pretty much for the most of this year, ADM has been stuck in a range, right? It's not performing like the S&P. It's not performing like a lot of other stocks. It's been kind of just in this range. And that range has been about between $64 and I would say $57. And right now we're at 60.85. So we're kind of right in the middle of the range. So this would be a stock, let's say, that what I would try to do is I want to try to improve the performance of this stock as it's just being range bound. So let's go to our expected move. And in this one, I'm going to allow a little time to pass. I'm going to let my call buyer have, the advantage, let's so to speak, let them pay for a little bit more. So let's go out to, again, our October's 51 days out. Our expected move here is about $5 or around $65.72. The upper range of our trading range that ADM would be trading. So do I feel comfortable selling ADM at $65? Yeah, I think I would be very happy, right, to get out of that stock. But if it doesn't get up to $65, what kind of call premiums can I anticipate? So here we are in October, and we can see the $65 call. I'm only going to receive 60 cents, and that is only 1%. So it's not there. It's not really there yet. I really want to get closer to about 1.5 to 2%. But again, let's think about where current price is and our delta. How much can the stock call strike price improve with a little bit of a rise in ADM? In other words, if ADM rises in a price value, let's say, somewhere between $2.50 and $3. Well, if I could get another $2 out of current price, I could add another 40 cents to my premium. So $1 on, let's say, a 62.50 stock price. Let's see what that comes in at. Gets me to that 1.5%, much closer to that threshold I want. But let's take another tack. Let's say I don't want to own Archer Daniels Midland anymore. I feel comfortable letting the market take stock away from me. Well, notice that even today on the October one, I could sell the 62.50 call and collect $1.35, which means my effective call away price is $63.85. Now let's go back to our chart, 63.85. Well, 63.85 would put us in the high end of that range. And would I feel comfortable selling the stock there? I think we could all agree that we would feel comfortable selling that stock. But if we go back and look at, now what were we in October's? Yes. 2.3%. And my potential gain, if I did get called away, would be a 5% increase. But think about this. If the probability is 1 in 3 that it will occur, that's 2 in 3 that it won't occur. And let's say ADM stays range bound, it doesn't get outside of that $64 range. Well, I'm going to be able to collect that premium. And then in another month's time or 2 months' time, I could redo this process and I could continue to do that. Now, let's take this one step further. And let's say, I really want to recoup this capital. I really want to redistribute Archer Daniels, but I'm going to wait until the end of the year. I'm going to take it as a tax loss. So let's look at the December expirations. And again, this is today. I'm willing to sell at $62.50. Well, I can collect $2.65, which gives me the effective price of $65. So I'm kind of asking the market to take this away from me, right? So I'm increasing the value of my shares, and that selling price at $62.25, excuse me, $62.50 is effectively $65.15. Now, is that worth it in terms of time, right? In terms of capital? Well, it's 114 days or about 4 30-day periods. Well, 4 divided by 460, 4.6 would give me better than 1% for every 30 days. So here again is a great example of giving our call buyer more time allows me to set a strike of a higher price and an exit price of greater value. Okay, so I want to talk about buy rates in a second, but I do see a few questions that have popped up here, Gene. So give me a second here. I do want to kind of run through a couple of these questions. And I'm sure we're going to get some questions about reassessing.
While John is reviewing those questions, let me just remind everybody out there that covered calls and all of our different option strategies are part of a Barchart Premier membership. If you are not a Premier member, we do offer a free 30-day trial. You can simply sign up. You'll get access to all of the different option screeners, including covered calls, which John is going through today. And you'll have a whole lot of other additional tools and features available at your disposal. So if you're interested in doing that, go ahead and try that out, and you can follow along with some of the things that John was doing today in the session.
Awesome, Gene. Yeah, I think that's really one of the great benefits of being a Premier member is just having access to all these option screeners and the ability to excuse me, manipulate them. So Glenn asked a question about leaps. Glenn, I have a webinar. Go into the archive webinars and just type in leaps where I address your question. Okay. There's a question that could you sell an in the money call if you want to get out of the stock? Yeah, let's take the case of ADM. Here's where we can see a $60 call, right? Well, I'm going to get $3.90, and that means my effective price is close to around $64. If I feel comfortable with that, yeah, that'd be fine. Now, notice also, what am I going to get in case, let's say, we wake up 114 days from now and ADM is not $64 and maybe it's $60.80. Well, I'm going to get 5% return on my asset on a stock that doesn't move. So yeah, I think there is a lot of promise that looking at strikes that are in the money, increasing that probability. Here you can see it's almost 50-50 that stock will be called away. You just have to be happy with the effective sale price of the stock plus the premium and the strike price. Okay. So there's a question from Dan about rolling considerations to number one scenario. I'm guessing he's guessing about the NVIDIA example. So I guess what you're saying is I wake up and I'm very close to being called away. In other words, we get the big price movement. So I think there's a couple of ways you can approach this. The first way you can approach this is, you can roll up. In other words, buy back that call that you sold and then sell a call at a higher price. Again, creating a greater profit potential. But I have to make sure that I'm not doing it at the cost of the rollover. In other words, if I'm rolling over and it's costing me more to get out than it is for me to re-enter, in other words, a deficit, then I'm probably not going to do that trade. Now, let's say time has gone for a while and you might have some theta decay, another time decay, where you could roll up where you don't have a deficit. Maybe it's break even, or maybe you actually get to collect a little bit of premium as you do that roll. Then I would be more inclined to roll up. So I think it's about that deficit and how much is that deficit going to take away from not only the if flat return, but that potential return. So keep that in mind. I think that was Dan. What is your strategy when the stock you did cover to call drops 10% or more? And would you ever sell a call at a strike price lower than you bought it? So I think we kind of talked about selling in the money calls. Again, that's one of the risks of the cover call strategy. It does not protect you from a large price decline. And if you think your stock is going to fall in price over the next X period of time, then it's cover call is not the strategy you should be doing. You should be doing some kind of a put strategy or some kind of bear market strategy. But again, if you sell an in the money call and your stock falls, in this case, let's make the assumption that Archer Daniels goes from $60, instead of going up, it goes down to that $57 range. Well, if I sell that in the money $60 call, I'm going to get $3.90 worth of premium. So that does buffer that downside risk. In other words, in this case, it would give me, a downside buffer of, was that $56.10, which is on the lower end of the range of where Archer Daniels has traded. So what I might do at that point is once the stock gets below $57, because I know that I have that protection down to like 56.10, then I might make an assessment as well. I'm just going to dump the stock anyway, or I'm going to get out of it. Or maybe I'll use that credit. And this is another type of strategy. I could use that credit that I'm collecting to buy, let's say, a put to protect me for even greater price loss. So think about that. I think that was Johnny who asked that one. So Patricia, is selling weekly covered calls more profitable than monthlies? Well, Patricia, what do you think? If time is money. Go back to the beginning of our webinar, and you'll see that we talk about that. I think you'll discover that selling weekly calls, you can get some nice returns, but selling monthly or longer dated calls are going to give you a much greater return. So Pablo, do you follow the 1% monthly rule? Yes, we talked about that, Pablo. Yes. I think I answered a lot of these questions. So now I ask, is there a multiple if you sell more than one option? If obviously that would be yes, right? Options multiple. Just remember, one option represents 100 shares. So you can't sell a covered call unless you at least have at least 100 shares of a particular stock. Okay. So Scott asks, do you take into consider volume for trading? Yeah, I think that is a very good point. And the point that I think Scott is making, like in the December options, there's not a lot of volume activity. So again, Scott, so that kind of is a really good point. Is you know, kind of a tip here, and I think this is a very obvious tip, but you'd be surprised how many traders um, do just the opposite. Is wait for up days to sell calls and buy puts, and wait for down days to buy calls and sell puts. So if I'm looking at a low volume market, yeah, I might have to take the bid. But you know what? Even just a small increase from the bid, can have a distinctive advantage or change in the price or that valuation of that percentage of that if flat return. So a lot of times if I have a light volume option, what I might do is, again, I might just set an order, right? I'll let the market come to me, right? I might not take the bid. I might do what I call in between. If I have a wide bid ask, 10, 15, 20 cents, maybe I'll do something that's in between. Because remember, a market maker is going to bid to you a price where if you sell to them, they will be able to lock in profit at that time. In other words, they're making money off of you. So you might be able to actually get a better bid price. Just have to have a little bit of patience, especially if you have a low volume market. All right, so where are we at? Okay, we're getting close to the top of the hour, so let's move on. If I didn't answer your questions, I apologize. Send your questions to support@barchart.com. We have a lot of support guys that are our options traders, and I'm sure they can help you with your questions. So I see a lot of questions here. Wayne, I didn't get to your question. I apologize, I didn't. So let's move on. One more point I want to get to. Okay. So initially what we talked about was that the cover call screener is under this assumption of what is called a buy right. What is a buy right? Well, buy right means basically that it's an option strategy where I'm going to buy the stock at the same moment, sell the covered call. And again, that strategy is best suited for stocks that have positive price momentum. In other words, are in an uptrend. And again, we're not worried about being called away. Matter of fact, we want the stock to be called away. That's how we're going to achieve our maximum profit. Now, the considerations or the criterias are the same that I just went through with if I already own the stock. So that would be, I'm going to look at that potential return because I want that stock to be called away. I want to look at the net debit. Now that is something a little bit different. In other words, how much is the offset of the premium I'm going to collect based on the value of the stock that I'm going to buy? And then again, that flat to return. Now, although strike premiums and dividends can offset the initial purchase price at that risk, they do not protect us from potential large downside losses. So let's go back to the options. Options cover calls. And again, this page is generated and it is sorted by potential return. Now, this ATSS, which is kind of interesting, this was actually a stock that somebody brought up in our market on close for our Premier and Plus members on Fridays. And this is a aerospace space stock, and not making a pun here, does this stock have positive momentum? Yeah, I think you can kind of say it has, but it looks like to me, again, it looks like a rocket ship that is now looking to come back and land on the moon. So I don't know if this would be a great candidate. Plus the generator here, here's a $28 stock and we're selling a $50 call or $55 call. What is the probability? What is the expected move of that event occurring? Now, yes, you do collect a large premium, but you're getting a huge price movement. Remember, if I'm doing a buy rate, I want a higher probability of being called away, and that probably means that stock is not going to move 94%. So let's kind of change this moneyness around, and I'm going to sort, and now I'm going to think about, what would be a typical kind of movement that would allow me to have a higher probability of a stock price calling away. So let's say, over the next 30 days, 5%, 10% would be something that would be, a kind of effective. Now, it's kind of funny is how I did this morning. We didn't have a lot of, I got to go out a little bit farther. So I got to go out a couple of pages here. So as the day goes on, you get a lot more results. So let me see where we're getting close. We're getting close. One more. Patience, patience, patience. All right, I think this will do it. All right, so look, I'm looking at an event of, let's say, 10%, right? Is that something that could be achievable, right? Especially in maybe a stock that has some higher volatility. And that one that has been trending or has been trending positively for a long period of time. Well, there you go. There is our NVIDIA. And our NVIDIA, right, here's the 138 strike. Again, we looked at the expected range, and this is for the September monthlies. That's only about 17 days away, or I guess it's a little bit more, 21 days away, 22 days away. Right? What was the expected move? Well, I think the expected move was closer to like around 15 to 20%. Well, it only has to move 10%. So I could buy NVIDIA today, and if I get that positive price appreciation based on earnings and it gets above 138, then I could make 10% return on my stock appreciation. Plus, I'm picking up $5 in premium, right? And so my potential return would be 15%. Now, that would be a 15% return on a stock that I only own for less than a month. I think we'd all agree that you would sign up for that. So again, this buy right scenario, look for those stocks that have a lower moneyness, in other words, strikes that are closer to current price, a higher probability of being called away. But again, look at what you're going to get for if that event doesn't happen. In this case, that 138 strike would give me 4.2% on only about 22 days worth of time. So that would be definitely something that I would be thinking about. Okay. All right. So let's end it there. So as Gene said, in order to have access to our option screeners, you need to be a premium member. We do offer a 30-day trial to our site. I would say this is what we call a risk-free event. I think, you give it a shot. I think you will be well rewarded. And again, you get to come into our Friday Market on Close show. All right, next week, we are off. Matter of fact, we're off for a couple of weeks. I'm going on a little bit of a summer hiatus. I think I deserve that. So anyways, but upcoming webinars. And again, under here, this is where you can find those archives. I think there was a question about leaps. You can come in here and just click on archives and then type in leaps and search and you'll find that. But in September 18th, about 2 weeks from now, we're going to do a webinar on our proprietary indicator, which is called the trend seeker. And what's is really cool about this tool that's in Barchart is not only does it help me define entries, but I can also use it for risk management. In other words, for exits. So come and join us and check that out. Until next time, folks, best of health, manage your risk, and the good of all trading.